$63,000 a year. That's what my portfolio pays me right now. Not projected, not backtested. Real cash hitting my account every single week. And here's the thing. Last year, that same portfolio only paid me $40,000. Same account, same broker, no massive deposits, no lottery ticket, no lucky stock pick. So what changed? 3 moves. That's it. 3 specific moves that took my income from $40,000 to $63,000 in about 12 months. And the one that made the biggest difference? It's the one most dividend investors have never even considered. Today, I'm going to show you every single move, the exact funds, the real numbers, and the simple math behind a 10% yield portfolio. By the end of this video, you'll know exactly how I did it, and more importantly, you'll know how to decide if this kind of strategy fits your situation. Quick note, I'm not a financial advisor or government employee. Everything here is for educational purposes only. For your specific situation, always check with a qualified professional. Now, let me tell you about Ray and Gloria. Ray is 62, Gloria is 60. They live outside Detroit. Good jobs, solid savers. They've been putting money into SCHD for years. They had about $600,000 and SCHD was paying them roughly $20,000 a year in dividends. $20,000 on $600,000. That's about 3.2%. Not bad, but not enough to retire on. Gloria did the math one night. To get $60,000 a year from SCHD alone, they'd need almost $2 million. $2 million. They didn't have it, and they didn't have 20 years to wait. Ray looked at her and said, there has to be another way. There is, and that's exactly what we're going to walk through. The 40K ceiling, and why 3% yield traps you. Here's the hard truth about SCHD. It's a great fund, one of the best, up about 20% just this year alone, almost $100 billion in assets, a 10-year dividend growth rate of 9.3% per year, expense ratio of just 0.06%. I love SCHD, I still hold it, but it has a math problem for anyone close to retirement. At 3.2% yield, you need $1.25 million just to generate $40,000 a year. You need almost $2 million to get $60,000. Now, if you're 35 and you've got 3 decades of compounding ahead of you, SCHD is perfect. The dividend grows, your yield on cost climbs, time does the work. But what if you're 55 or 60? What if time is the one thing you don't have? That's the trap. It's not that SCHD is bad, it's that SCHD is built for growth. And when you need income, growth and income are not the same problem. Think about it like this. $40,000 at 3.2% requires $1.25 million in capital. That same $40,000 at 10%, only $400,000. Same income, radically different capital requirement. So the real question becomes, how do you go from 3% to 10% without chasing garbage? That's exactly what the 3 moves answer, and the first one is the biggest.
The 3 moves that tripled my income. Move number 1. This is the one that changed everything. I rebalanced. I took a portion of my SCHD, not all of it, and dollar cost averaged into covered call income ETFs. What's a covered call ETF? Simple. The fund owns stocks. Then it sells options contracts on those stocks. Those contracts generate cash, and that cash flows to you as income. The trade-off is real. You give up some upside. If the stock shoots up past a certain price, the fund doesn't capture all of that gain. But in exchange, you get paid every month, sometimes every week. Here's what the core of my portfolio looks like now. SPYI, the NEOS S&P 500 High Income ETF, about an 11.8% distribution rate, monthly. QQQI, the NEOS NASDAQ 100 High Income ETF, about 14%, monthly. JEPQ, JP Morgan's NASDAQ Income Fund, about 10.5%, monthly. JEPI, JP Morgan's S&P 500 Income Fund, about 8.3%, monthly. GPIQ, Goldman Sachs NASDAQ 100 Premium Income, about 9.3%, monthly. GPIX, Goldman Sachs S&P 500 Premium Income, about 8.7%, monthly. IWMI, NEOS Russell 2000 High Income, about 14%, monthly. 7 funds, all paying monthly,
all between 8 and 14%. Then I kept SCHD as my growth anchor, lower yield but full market upside and a dividend that grows every single year for the last 15 years straight. And on the edges, small positions in CHPY and QLDY. These are high-yield satellites, 35 to 45% yields, weekly and twice-weekly payments, but small positions. These are not the foundation, they're the accelerators. Blended all together, about a 10% portfolio yield. That's move number 1. Move number 2, I built an income calendar. My quarterly SCHD payments used to be my only payday. Now I get paid every single week. Monthly payers land in different weeks. Weekly payers fill the gaps. Twice weekly payers from QLDY cover the rest. It's not one paycheck a quarter anymore. It's income flowing in every 5 to 7 days. That changes how retirement feels. Move number 3, drip compounding. Every distribution buys more shares. More shares generate bigger distributions. Those bigger distributions buy even more shares. Here's the proof. $10,000 in SCHD 10 years ago grew to about $29,000 with drip turned on. Without drip, only about $25,900. That's a 31-point gap just from reinvesting. Now imagine drip at 10 to 14% yields instead of 3. The snowball spins much faster. Before I show you the part most people miss about that 10% yield, drop a comment right now. Are you building an income portfolio for retirement, or are you already living off of yours? I read every single comment. Now, here's where I have to be honest with you, because that 10% yield is real, but it's not what most people think it is.
The honest truth about 10% yield. Here's the myth. A 10% yield means you're earning 10% income on your money. Here's the truth. Most of that 10% is something called return of capital, ROC. What does that mean in plain English? It means the fund is giving you back a portion of your own investment as a distribution. You can spend it, you can reinvest it. It's real cash in your account, but it's not all profit. Return of capital isn't taxed when you receive it. That sounds great, but it lowers your cost basis, meaning when you eventually sell, your taxable gain will be larger. Now here's where it gets important. Not all covered call funds are equal. SPYI and QQQI have shown stable or rising prices while paying 11 to 14%. Their total return, price change plus distributions combined, has been strong. SPYI has paid 42 straight monthly distributions, and its share price has gone up about 6% since launch. Now compare that to YBTC, the Bitcoin covered call fund. It pays about 35% in distributions, but its price has dropped over 30% in the last year. You collected income but lost more in value than you received. Or ULTI, the Rex Income Max Fund. It's lost roughly a third of its value since it launched in October. Same concept, opposite outcomes. The lesson? Headline yield alone is meaningless. What matters is total return. And one more thing for anyone close to retirement. How you hold these funds matters for taxes. JEPI and JEPQ generate ordinary income. At a 32% bracket, an 8% yield becomes about 5.8% after taxes. These belong in your IRA or 401k. SPYI, QQII, and IWM use index options with special tax treatment, 60% long-term, 40% short-term, much more efficient in a taxable account. And watch your income levels. If your modified adjusted gross income crosses $218,000 as a couple, you'll hit IRMAA surcharges on Medicare. That's roughly $2,300 extra per year. Return of capital doesn't count toward that threshold. Neither does Roth income. So where you hold these funds can save you real money. Now, knowing all of this, what does the full blueprint look like? The 63K blueprint and what's next. Let's go back to Ray and Gloria. They started with $600,000, almost all of it in SCHD, earning $20,000 a year. Here's what their portfolio looks like now. About 15% stays in SCHD. That's their growth anchor. Full market upside, a dividend that grows about 9% a year, long-term wealth builder.
about 70% sits in the Sustainable Income Core, SPYI, QQII, JEPQ, JEPI, GPIX, GPIX, IWM. These pay 9 to 14%, monthly distributions, moderate risk, proven track records. The remaining 15% goes to high-yield satellites, CHPY, QLDY. These pay 35 to 45%, small positions only. Gloria calls it their fun money engine. They know the risks, they're sized for it. Blended yield, about 10%. Annual income, roughly $63,000. Monthly average, about $5,250. They didn't need $2 million. They needed the right structure. And here's the best part, that $63,000 isn't static. SCHD's dividend keeps growing. The covered call positions keep compounding through DRIP. Next year, without adding a single new dollar, the income should be higher. The yield didn't grow because the portfolio got bigger, it grew because the strategy got smarter. That's the whole idea. It's not about chasing the highest number, it's about building a system, growth, income, and compounding that works together. If someone you know is building toward retirement income, share this video with them right now. It could change how they think about their entire portfolio. Now I want to hear from you. What's your current portfolio yield and what's your target? Drop it in the comments. I want to see where everyone's at. If you're building dividend income and want to stay ahead of moves like this, subscribe to this channel. I cover everything that protects and grows your income. And next up, I'm covering a brand new sector I think is about to rival semiconductors for dividend income investors. You do not want to miss that one. I'll see you in the next video.